Now, here's another part about IULs that very few people understand. It's kind of high level, but I'm going to try and make it as simple as possible. Because when I read up on Kyle Busch, I realized he was explained incorrectly anyway, because he thought he was investing in the stock market. He was not investing, and he wasn't investing in the stock market. An IUL is not an investment. You don't need an investment license to sell it. You need an insurance license. Why?
You know, I do infinite banking, and there's people out there talking about IUL using infinite banking. That's a curse word to real IBC practitioners, because they're completely different products from an underwriting standpoint, from an actuarial standpoint. And so what happens is every year you get older, insurance costs more, right? So if the extra money doesn't keep up with the cost of insurance, it's going to lapse. So it could work, but you have to babysit it.
So we are going to get to the bottom of the whole life insurance scam thing versus IUL. Let me give you some context. A couple months ago, NASCAR driver Kyle Busch and his wife went public with the fact that they feel like they got scammed on an IUL policy.
We're in litigation with Pacific Life in regards to IUL policies and insurance policies that are also retirement policies.
It was a major scam. By investing money in this scam, it's all gone. This just isn't happening to athletes and celebrities.
Right.
This is happening to teachers, police officers, veterans. This is happening to widows, and they buy into these scams and they lose absolutely everything. This was a huge and utter scam.
When I saw the video, I noticed that people were in the comments and other people were reposting it talking about, this is why I canceled my whole life insurance policy. IUL and whole life insurance are very similar, but they are not the same. Whole life insurance is insurance that pays a death benefit and accumulates a cash value along the way. Some of y'all are like, I already know this. We just got to make sure we're all on the same page, because some of the stuff that we're going to talk about later in this episode is going to get real complex, and I need to make sure that you got a good foundation understanding. An IUL is a form of life insurance with a death benefit, but also the cash value grows based on the performance of an index. Some of y'all like, whoa, 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 whoa. What does that mean? Don't worry, we're going to uncover it. Okay. So I wanted to make a video clarifying the differences, and I want you to be able to take advantage of the big giant $8 million loss that Kyle Busch and his wife they're saying that they took. Don't forget, this is not investment advice. Repeat after me. This is not investment advice. I am the captain of my own soul. As we uncover it, what I did was I hopped on the phone with two of my really closest friends. Actually, one is a really close colleague. Shout out to Curtis. And the other person is a really, really, really close friend. I asked them, like, hey, break it down, how it works. So the first person we're going to hop on the phone with, Tank. Tank is one of my oldest friends, okay? He is a great teacher. He's great. He's probably one of the smartest people I know. He's great at explaining things. Let's hop on the phone with him so he can break down this whole Kyle Busch IUL insurance thing. Gonna call him right now. Hey, how you doing?
What's good, miss? I'm well. Yourself?
I'm good. Real quick, before we go into this conversation about IULs and life insurance, this Friday, I'm doing a Christmas conspiracy party. It's going to be a couple people. We're getting together, and everybody's got 5 minutes, and you can do PowerPoint if you want to, and you're going to explain your favorite conspiracy.
Oh, I'm down. I got a bunch of them I got to choose between, because I'm a conspiracy theorist, but I will pick my favorite one.
So, in your best, most concise way, explain the difference between IUL and whole life insurance.
The quickest way to understand the difference between the two is that whole life, the money that you get inside of your policy, the cash value, the growth is determined by the insurance company's investment portfolio, normally offered by very secure and old, I use the word venerable, but people don't know what venerable means, so I just say old insurance companies that have been making money for 150, 200 years. They pay a dividend every year based on how they invest their money, and they invested in a myriad of things, bonds, commercial paper, whatever they want. An IUL is an insurance company crediting your account, but they're crediting your account based on the performance of stock options that they buy on a particular stock market index. So the most popular stock market index is the S&P 500. They will buy options. An option pays them if the market goes up. It doesn't pay them if the market goes down. They buy the options. They give their policyholders a percentage of the money they make off the options.
So how did Kyle Busch end up in the situation that he's in with IULs?
So one thing about IULs, I have a theory that everything that comes out as an investment product is a good thing. That's my belief. And it's not just because I'm in the financial services industry. It's because things are regulated, things are vetted before they are allowed to reach the general public. The problem is, if everything's a good thing, why do people get screwed over all the time? It's an old saying in our community, everything ain't for everybody. And IULs have such a specific and myopic use audience. And unfortunately, it gets shown to people who have no business getting them. The irony of this story, though, with Kyle Busch, he is the ideal person who should get it. But they did him dirty in the structuring of it. They did him real dirty. When you buy, I work with professional athletes, entertainers. I've done probably about 20 IULs the way Kyle Busch was told his IUL would work. They basically said, hey, you put money in for 5 years. I don't know why they picked 5 years with him. I normally do it with ball players who have contracts. And I'll tell them, give me 3%, 5%, 1% of what your contract is going to pay you over the next 5 years. Let's throw it in the IUL. Set it and forget it and let it sit there for about 15, 20 years. And it looks like the way his was explained to him at age 52, I guess Kyle Busch is a younger, in his late 30s or whatever. So he was probably showed this thing at age 32, said, put this money in for 5 years, don't touch it for another 15, 20 years, and you'll be able to take money out for the rest of your life. That's exactly how it's supposed to work. The problem is, as I looked into his situation, they made the life insurance part way too high. When you sell somebody something in an insurance policy that has two components, cash value and a death benefit, and you're telling them it's specifically for the cash value, you're going to use this in your retirement, that's the part you want to focus on. However, getting the death benefit as high as possible helps the commission and the person who's selling it. So what they should have done was squashed down. It's a very technical term we use, squash. They should have squashed down his death benefit and directed more of the money to the cash value growth. And that would have helped the policy do what it was supposed to do.
You said that he's a very specific person that would need it. What's the profile of the specific person that would be ideal for IULs?
High net worth. High net worth with what we like to say FU money. Money that you can put away that you don't need. The last thing you want to put someone in the IUL is someone who's calling you every third week about their $150 a month premium payment, not sure if they can make that or their AT&T phone bill. IULs are best used when they are what is known as, the word is called overfunded, when you put more cash into it than is needed to pay the premium. Because once again, that extra cash goes immediately to work in the cash value part of the policy, not in the death benefit part. They kept his premium so associated with maintaining this $40 million death benefit that almost every dollar that went into his policy was directed toward the insurance side and not the cash value growth side. Now, here's another part about IULs that very few people understand. It's kind of high level, but I'm going to try and make it as simple as possible. Because when I read up on Kyle Busch, I realized he was explained incorrectly anyway, because he thought he was investing in the stock market. He was not investing, and he wasn't investing in the stock market. An IUL is not an investment. No matter how many people try to tell you it is, it's not. You don't need an investment license to sell it. You need an insurance license. Why? Because you're not putting your money into the stock market. You're giving your money to the insurance company. The insurance company is promising you to credit your sub account, credit your cash value account as they see fit. And they see fit based on how much money they make in the stock market on the options that they buy based on your money. So you're not directly investing. The insurance company is, which is why they can promise you can't lose money. They're buying a stock option on something, which means that if the market goes up, they cash in because their option went up. If the market goes down, their option just expires worthless. It doesn't cost anything. So they can say you can't lose money. We all know technically that's not true because the policy has expenses inside of it. And let's just use a number like 3%. Every year, your policy is going to extract 3% of its value out to pay the insurance company expenses. So if you didn't make any money, get the credit, You still lost 3% of your value because the expenses exist
and
every year.
3% compounds every year.
Every year. So you want to overfund these policies. You want to give the insurance company a huge bucket of money to go play with the options with. And then when they credit your account, you're seeing gobs of bread come into your cash value account. If you are not overfunding it, and if you're buying, so in IULs, they have 3 different premium levels. They have the minimum premium, the target premium, and then what's known as the MEC premium. The MEC premium is the one you can't pay over, or you turn your policy into a MEC, modified endowment contract, and then it becomes not tax-free anymore. So you definitely want to avoid that. You have people saying, oh, I'll just pay the minimum. If you're paying the minimum, you're covering the cost of the insurance. You're giving yourself no growth in the cash value part. You want to not only not be paying the minimum, you want to pay as close to the MEC limit as possible. You want to overfund the policy, let that cash value grow. Don't let it go toward the cost of your insurance. And then you're sitting on a tub of money that you can distribute tax-free in retirement.
Why do they even let you do the minimum, just in case you have like a bad year?
Yes, the flexibility is what's supposed to be attractive about an IUL. You have a bad year, or I'm going to stay with a ball player. You went free agent. You didn't sign for as much as you thought you were going to sign for. You can pay a minimum level, but then your agent, your insurance agent, not your sports agent, your insurance agent should come back to you and say, hey, I showed you an illustration based on you paying this much. You're dropping it down to this much. Let me show you how that affects you. They never come back and tell you that. Most of the time, they don't even pay attention that you switched from the one premium to another, because once they sell it, they're on to the next person. They're not normally a planner or an advisor who sees how this is working for you year in and year out. It's a one and done type of transaction.
Okay. How do you feel about IULs as a result of this? Is it like you just
my stance on IULs hasn't changed because of the Kyle Busch situation at all. You don't want to give a scalpel in the hands of a surgeon, great tool. A scalpel in the hands of a scorn lover, stay low. You know, it's just one of those things. I'm on one today. It's just one of those things where you have to realize who you're giving something to and why. So IUL still great for the very, very small percentage of the financial population that it's intended to be used for. What I didn't like about this whole story is them marrying and arm in arm and lumping together IUL and whole life. Whole life is a completely different product, much, much better suited for a broader demographic of people. But still, there are people who can't afford whole life. The problem is, and this is one I know there's a better analogy. I know you'll enjoy this because of your love of the Lord and the Bible. People often who don't believe in the Bible or Christianity point to the fact that our enslavers used the Bible to convince us we should stay enslaved. So that's a great example of something that's an amazing, great thing that in the wrong hands can be interpreted very badly. And stood on that argument. People can make a real strong argument that they thought they were well within their rights to use it for this purpose. Whole life has a very specific argument. If I meet a 25-year-old single mom, a 22-year-old single dad, a 30-year-old newly married couple with new kids, I'm not showing them whole life. I'm showing them term life. They need to replace their income for as cheap as possible to take care of their kid if something unexpectedly happens to them. When I meet a more developed set of people, 40-year-olds, got some disposable income, now we want to look at the cash value growth inside of whole life as an alternative to underperforming assets like money market accounts or even treasury bills. The cash value inside of whole life policies on a risk-adjusted basis outperforms everything but the stock market. It's really a wonderful growth tool, but you got to have the bread to be able to do it. And unfortunately, and I overhear these conversations, I keep to myself and just laugh, you hear people, normally lower income people, calling whole life a sham or this, and this, because it's not for them. They can't afford it. So of course it looks like a scam to you. If I told you you could self-insure for your automobile, but you got to have a nest egg of $500,000 sitting in a bank account in case you ever do run over a small child, that knocks out almost all of us. We don't have $500,000. And if we had $500,000, we definitely can't afford to leave it in an account that's doing nothing for us in case we hit somebody. But if I'm Elon Musk or Bob Johnson or somebody who has the bread, hell yeah, I'd rather put the $500,000 to the side in a account than pay $3,000 every 6 months for auto insurance. Everything isn't for everybody.
Fact. One other question. So the only difference between whole life and IUL is the fact that IUL invest in options and whole life invest in the actual asset.
So whole life, the insurance company is paying you a dividend based on how their investment account performs, and they're very prudent with the investments that they buy. And most of the big insurance companies, I always call them the big four, New York Life, Mass Mutual, Northwestern, Guardian, they have been paying an insurance dividend for over 150 years. They never miss payments, and they pay it based on this sub account that they're investing in. The IUL, here's another reason why IULs should be really deeply looked more into. You're talking about a stock market that you're getting a credit for. They're illustrating it like you're getting the return from the market when you're not. You're getting the return from them. Well, if you know anything about the stock market, when people tell you the stock market historically returns 10% a year, there's a little asterisk next to that every time that says it returns 10% if short-term capital gains and dividends from the stocks in the index, when you receive them, that you reinvest them. Well, once again, because you're not actually investing in the market, you're only buying options, there's no chance to reinvest those short-term capital gains or dividends. And if you really break down that 10% historical return, 35% of it comes from the reinvestment of the short-term capital gain. So you're really the market itself only returns 6.5% a year left through accumulation. It gets up to 10% because of that reinvestment of short-term capital gains and dividends. And by buying an IUL, you're cutting yourself out of all of that.
Listen, IUL only if you ain't got no other place to park your money. This is my
IUL if you stupid rich. IUL if you have, what I tell people, think of your investment options as like columns that can be filled up, like test tubes that can be filled up. And you done filled up the first 7 of the ones that we all know, understand, and rock with, and we still got money left. Bring me the IUL column. Let me fill that one up. It's a very rare situation indeed for you to be rocking with IULs.
Okay. All right. Thank you. Big
You're welcome, cuteness.
Love you. I'll talk to you later, okay?
Mwah. All right, babe. Talk to you later. Bye.
Yeah, I know. I told you he's so smart. Okay. It can get a little bit deeper. I want to give you all another perspective on all of this. And by the way, if you want to reach out to Tank, his information is down below in the description, okay? I know my other friend, Curtis, he has a different perspective on this. And I want you to be able to be empowered to make your own decision, okay? So I want you to hear the other side of this. Let's hop on the phone with Curtis. What's up, Curtis? How you doing?
I am good. I'm great.
So we don't have a whole lot of time. I know you got calls back to back, but I'm so glad you took this call with me because this whole Kyle Busch IUL thing, and then now people are clumping IULs and with whole life insurance, and whole life insurance has been like a cornerstone of my legacy planning, and I'm scared. So can you break down what's going on and what really is going on? Explain all of this.
Sure. Well, you shouldn't be scared because they're two different things. Okay. And so I haven't gone deep into the Kyle Busch thing, but I know how I know the company and I know how IULs work. I sold them, for lack of a better word, for like 5 years. And then once I realized how they worked, I stopped. So I haven't done one in almost 20 years.
What? Yeah. Okay, break it down. What's the difference between the two?
So basically, there's 3 types of insurance. Okay, so there's I'll send you a video I have on it because when I have to explain something more than 3 times, I just make a video. But what happens is there's 3 types of insurance. There's term, which is just you buy it for a time period, right? And then when if it's a 10-year or 20-year term, when the term is up, it doesn't end; it goes up to the wherever you got to buy it at your what's called your next age, your attained age, right? So that's important to remember when I go into universal life. Then there's whole life, right? So whole life is, and I'm biased because I like certainty, right? So it's guaranteed. If you pay the premium, the policy will last to 120 and you really can't screw it up. Okay. And then there's universal life. So there's 3 types of them, right? Fixed, variable, which is basically so fixed is just based on interest rates, is basically term insurance and a side fund. All right. Variable is term insurance, but the side fund are mutual funds, and IULs are term insurance, and the side fund is basically what the company does. This is going to be kind of nerdy, but basically what you would understand, they buy call options against the S&P. That's where the growth comes from. All right. And so people that tend to like them are most of the people in the industry because they sell performance, and they're easy to sell because the illustrations look good, but there's nothing guaranteed in the damn product, right? So everything, they shift all the risk to the consumer. That's what I don't like about them, right? Because basically,
so let me just be really clear. Yeah. If something does happen to you outside of the part that goes into the S&P, you'd still get your term benefit.
You still get your death benefit. So as long as the policy is enforced, so I tell people, look, your IUL term whole life, you know what the best insurance is? The one that's enforced when you die. Okay. But I wanted to guarantee that it's going to be enforced when I die. And there are so many different ways to fund the UL that's a blessing and a curse, because if you don't fund it right, it ain't going to last, because the insurance cost increasing, because term insurance goes up every year. It's called the mortality charge, could start to eat away at the cash value if the index doesn't perform like they're projecting, right? So they're all projecting. So with the Kyle Busch thing, it's even worse because they didn't fund it right. So when we talk about whole life, y'all, I do infinite banking, and there's people out there talking about IUL using infinite banking. That's a curse word to real IBC practitioners. Put IUL in the same sentence as Nelson Nash or IBC, because they're completely different products from an underwriting standpoint, from an actuarial standpoint. That's nerdy, different, right? And so what happens is every year you get older, insurance costs more, right? So if the extra money doesn't keep up with the cost of insurance, it's going to lapse, right? So it could work, but you have to babysit it. And so I don't want to do that. If I put somebody in a whole life and I don't talk to them, this won't happen. But let's say I don't talk to them for 5 years, I could go into it and it'll do exactly what I said it was going to do. That's what you want, like, because you're going to take risk in your business and your investments. You don't need to take risk with your safe money. And so what people sell, because they try to move the line between investing and insurance because it's sexier. And so that's the problem. See, insurance is safe money, right? So it's boring, like a CD. It's like what's that PNC commercial, brilliantly boring? That's what insurance is supposed to be. So you don't need to take risk, up to the markets without the downside risk, tax-free retirement. I've said for the last 15 years, that's a lawsuit waiting to happen. Okay. Because if you're making unreasonable claims, because they'll say, well, they'll back test these indices. And they say, well, based upon what the S&P has done for the last 20 years, they'll show you these illustrations, but they're just that, illustrations, right? Projections. You can project wherever the hell you want. And so therein lies the problem. They're easy to sell, but if you don't babysit them, if you don't check the indexes, you don't check your allocations, you don't check the rising cost of insurance, and you're just taking the advisor's word for it, the ones that were sold were front loaded. So if you're positioned right as a cash accumulation tool, then you're solving for minimum non-met. So how little insurance would IRS let you get away with as per their rules? And then you kind of make the policy work like a big Roth IRA. So you're trying to minimize the insurance coverage and overfund it with cash value, front loading it with cash value. And so from what little bit I've read, I don't know that was done. And so it was structured so that a lot of it went to what's called base premium. And so the agent makes a lot of money, but it's not necessarily structured for cash accumulation. And a lot of IULs, depending on the company you use, they have 10, 11-year surrender charges. So even if you fund it, you can't get to the money, all the money right away. So they're completely different animals, and you just gotta
What is it, like unlimited upside? Like, what is the benefit of doing
the
it?
benefit is not unlimited. Well, it depends on the index. Depends, because they have different indexes. So usually they were like, the index was, so let's say you had the upside up to a cap, let's say 12, 14%, and then you had a floor, but you couldn't go below zero, right? Because you're not, with the index in particular, you're not in the market. You're buying your market adjacent, you're buying call options in the market, but it's still a fixed product. That's why you don't need an investment license to sell it. Okay. But I just think people are too aggressive with it, because I like certainty. You know, that people talk about tax-free retirement. That's what he bought, right? But I don't think, see, my belief is that there's no product that will take you to glory financially. No single product, okay? Because financial freedom is from your brain. Like, your number one asset is you, right? And so you want to buy assets that send you a check without working. I don't think it should come out of a product, because the product ain't designed to provide cash flow, right? So now you stop, and here's what this is what gets me. So I'm probably off. So if agents who won't like me saying this, I'm just saying this is my understanding. That's why I don't do it. So you put this money in. Most people don't even fund it enough to do that, okay, to have enough money. And then you want to get a tax-free retirement. So now you're going to stop funding it. So now you've got an increasing mortality charge, cost of insurance, but you stop paying for it. So now you have a rising cost of insurance. You're not putting new money in. So now if the performance of the asset doesn't do like you said, they've got to start pulling money out the other side. And then now you got a tax-free retirement. So you're taking loans. That's where the tax-free retirement comes from. You're borrowing against your cash, but now you have no new money. Then you have the interest cost increasing and the insurance costs increasing, right? Oh, Curtis, you understand, we got wash loans and please, okay? You still have increasing cost of insurance. It's complicated. And I don't see, hope is not a good strategy, right? And so I don't want to hope it works. As an advisor, I don't want to hope it works.
You know what's funny? When it was pitched to me a long time ago, I was very confused, and I don't like to invest in things that I was confused about.
Yeah, that's what you know.
I understood how it worked, but I didn't understand like the risk mitigation. And so like here we are, and the risk has happened, and then the risk mitigation is not mitigating enough. Right. And that was my issue.
See, that can't happen with whole life. That's what you want. See, whole life is storage. It's not even an investment. People want too much from that. You know, the questions that we ask clients, where do you store your cash, right? So now you got access to capital in a tax-favored environment. You can now borrow against it to buy assets that you like, that you understand, that could cash flow. Your money is still working. You've got the asset, and the cash flow from the asset should pay the loan back off. And boom, now you can have your cake and eat it too.
You got to go. Let's talk later.
Okay.
All right. Thank you.
Okay. Bye-bye.
Okay, now that we have both sides of the argument, I want you to make an educated decision. How do you feel? What do you think? Let me know down in the comments. I know what I think. You want me to tell you what I think? I'm going to tell y'all what I think. But use your brain, okay? Whole life insurance is still a good, sound solution to building wealth. IUL, I'm going to go with Tank. It's just for a very specific person, somebody who has FU money. None of us have FU money, period, point blank. And to be quite honest, I don't know if, and by FU money, I mean like, I don't know if Kyle Busch, I don't know. I don't know what Kyle Busch's numbers do. I don't know. Like I said to Curtis, I didn't see how your downside risk was hedged. And I don't know how they didn't see that, because they were outsourcing the decision making. You cannot do that. The other thing I want to talk about, they use this word in their video multiple times. We got scammed.
This was a huge and utter scam.
This is also on the heels of the fact that another real estate guru got exposed for scamming people. And I'm noticing a trend, right? And so these two things have nothing to do with each other than the fact that we're using this word scam. I'm noticing this trend as I'm looking at both of these cases and both of these instances and peeling back the layers. When people lose money on something that they never understood, they always go to the word scam. They always go to the word scam. And the reality is people get greedy. They invest in things that they don't fully understand, and they don't want to fully understand them. And they literally fully delegate the responsibility of understanding their investment to someone else. The reality is sometimes you lose money. Sometimes we lose money. Period, point blank. That is what it is. Because you lost money doesn't mean it's a scam. It only becomes a scam when you lose money on something that you willingly did not understand. There are people out there that want to take advantage of you. Absolutely. I'm not saying that Kyle Busch's people didn't want to take advantage of them. I'm not saying that the person that just got exposed for being a real estate scam artist, this is what they say, that they didn't want to take advantage. But the actual scam only happens when people willingly do stuff that they don't understand because they're lazy and they don't want to actually fully understand what they are investing in. That is just my take. I do agree that people out here are doing stuff wrong, for sure. But this is why the Profit Door exists, and this is why I make these videos, because I want to empower you. Sometimes investing aggressively, not sometimes, always investing aggressively, or when you are changing the trajectory of your lineage, your bloodline, going from scarcity to abundance, if you are going to be the person to be able to do that, you have to not be lazy and fully understand so that you are empowered to make decisions and understand, hey, this is a riskier investment. I'm willing to do it. I may lose money, but I'm going to allocate this amount of money. You are doing it with full lenses, right? I took some losses, major losses, but I'm not going to say I got scammed. It just happened. These things happen. And what am I going to do to make a better decision going forward? This is why I want to empower you, because a lot of you have financial advisors and you're giving everything over. I have a personal friend who put all their money, a lot of their money, with a financial advisor and lost a lot. I'm not saying your financial advisor is bad, but what I'm saying is you have to empower yourself. You have to educate yourself on some of these things. I'm not saying IUL is not a scam at all. I'm not saying whole life insurance is not a scam. I'm not saying that. What I want to do is empower you with the decision to be able to look under this and figure out if this is a good investment for you. Okay? So if you want to learn how to educate yourself on some of these things, go to the link down below. I do a little workshop regularly called the 7 Hidden Wealth Keys. Go down below and register for the workshop. I hope to see you soon. I go through some major things that you would need to know to empower yourself so that you don't get scammed. Okay? All right. I love you all. I'll see you soon.